All right. Hey, friends. Dan Passarelli here. How are you feeling today? I want to make sure you can hear me. Please make your way on over to the box where you can type and let me know that you can hear me, please. I would very much appreciate that. Hey, there we go. Hello, hello in the Q&A box. It is Juan and Justin and Mike, some of our usual suspects, which I love. Nothing I like more than frequent attenders. Kaylin, how are you? Very great to hear from you. Nelson, all right. Okay. Well, folks, today we're going to talk about something pretty important. Did you ever notice that there are a number of things in life where it's human nature to think, well, I don't need that thing until you need that thing. And then you really wish you had that thing. Well, right now, for those of you who are watching this live on, what is this, August 19th of 2025, U.S. stock market is pretty close to all-time highs. And who knows, might keep climbing and make new highs. Might turn around and have a pullback. One thing I know for sure, at some point, there'll be a pullback. It might never get lower than it is today. It could have a big run up and then a pullback. But if you plan on investing, and I'm speaking more to the investors here than the traders, which it's my experience that most traders invest also. If you're planning on investing for the long haul, like not just for the next month, but for the next decade, which probably you are, most of you, then at some point, what we're going to talk about today is going to come in pretty darn handy. Now, it might come in handy today too, because even though the S&P 500 is up, most of the stocks in the S&P 500 are down. Isn't that weird? S&P 500 is a capitalization weighted index, which means the bigger stocks matter a lot more to its price. The so-called Magnificent Seven stocks make up 35% of those 500 stocks. They matter as much as about 160 stocks should if it was not capitalization weighted. So you might have a stock in your portfolio right now that can benefit from the stock repair strategy so that you can potentially recoup losses on losing stocks. Before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're talking about here today is general information, not specific to your personal situation. Now, I see a lot of friendly faces here, folks in the market taker family for sure, like Kaylin and Juan and all the folks I read earlier who I said are longtime friends. But for those of you who don't know me, allow myself to introduce myself. My name is Dan Passarelli. and I am an author of two of the most popular option trading books, working on my third. Not to mention a weekly subscription article on Substack, which I know many of you subscribe to. And I do daily videos. I've written articles for a lot of the top option trading publications. Been quoted by, I don't know, a lot of people. Reuters, Dow Jones, Barron's, CNBC, been on Bloomberg Television. So I've been around a while, not trying to give you my whole resume or anything here, but I got there from being a trader. I was a professional trader for many, many years on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, traded as a so-called upstairs trader, and now I trade in a retail trading account just like you. I'm also the founder and president and chief dishwasher of Market Taker Mentoring, which is the global leader in option trader education. We've got students in over 50 countries. We have trained tens of thousands of students to go from where they are now in their trading to reaching the goals they set for themselves. And I'm also a trading industry collaborator. I work with the best options-friendly brokerage firms, like, of course, Firstrade here, as well as most, if not all, of the options exchanges literally in the world, from the domestic ones, of which there are now 16, 17, I don't even know how many. They keep adding them. But as far as the exchange groups, CBOE, NASDAQ, all of them, I've worked with all of them, as well as Shanghai Stock Exchange and Futures Exchange. I don't know, a whole basically all the global ones. And hey, you know what? All that stuff is really important to me. It's it's not just my career, it's a big part of my life. But the important part of my life is my family. Those of you who are market taker mentoring student traders or one-on-one coaching students, especially, you know Kathleen well. She is my wife, and she runs operations here at Market Taker. I have my two adult children who moved out of the house again. We're empty nesters. They might stay this time. They're getting older. Got my two cute little dogs. And I do other things for fun besides trading and family. I'm a runner, foodie, traveler. Just booked a trip for the spring of 2026, a European trip, which I'm looking forward to. And I'm a music person. Okay, enough about me. Let's talk about the important person here. Let's talk about you. In addition to everything we talk about today, I want to give you more training. I want nothing more than for you to be the absolute best trader you can be. And how do you do that? You do that by investing in yourself. And you're already doing that. There are two sources of capital you have: time and money. And time's the most valuable one. And you're investing your most valuable asset with yourself right now. You're putting your time in, and many of you put your time in week after week after week. And sure, to really drill down and get great at it, at some point, you got to pay for education as well. That is an investment too, whether that's books or videos or one-on-one coaching or whatever it is. But Market Taker Mentoring is your partner for investing in yourself, and we're honored to be that partner. So for those of you who have yet to do this, go to markettaker.com. two T's in a row. Market like stock market. Taker like take what is rightfully yours. Two T's in a row. Markettaker.com. And just go up to the top right-hand corner here to join free. And there are some free classes there. You get discounts on certain ancillary things. There's a whole bunch of like really, really great stuff that me and my team worked really hard to give to you at no cost, including our weekly newsletter and our daily video. All super helpful things. So do yourself a favor, continue investing in yourself, and do that for now. Question for you. Have you ever had a stock that lost money? No, of course not. We're all the best investors in the world. We have never bought a stock that lost money. I'm just here to twiddle my thumbs, and I love the soothing sound of Dan's voice. I don't need to learn anything. I'm the best investor in the world, said no one ever. Of course, you've had a stock that has lost money, but gosh, wouldn't it be great to get that money back? Well, let's talk about how to not get your money back. So there are a lot of novice things that traders do to try and get their money back. Sometimes using options that are just terrible ideas. And I said novice things. I thought for a fleeting moment in my mind to say dumb things, but you know what? While it's probably accurate to say dumb things, it is something that everybody does, present company included. I've done all these things. That's why you're here. If I didn't make a million mistakes, you got no business listening to me. You're shortening your learning curve by learning from my mistakes and triumphs, right? That's why you're here, to learn from somebody who's been there and done that. But there are some things that in hindsight are terrible mistakes that you shouldn't do. So let me save you both time of trying to figure it out over months and money that you don't have to pay to the market, and tell you just don't do these things. So here are some bad ways that I have seen and done for traders for investors trying to get their money back when they lose money on a stock. One is, oh crap, I bought the stock here, now it's here. I can't accept this loss. I'm just going to buy a bunch of calls because it's got to go back up, right? And when it does, I'll make all my money back plus some for pain and suffering, right? Who's ever done that before? Lift that hand a little higher. I know you did. I've done it before, and it's a mistake. How about this one? Selling puts or put spreads for basically the same reason. This is something that people do who make the same mistake, but they're just a smidge smarter about it. I sold the stock here. Now it's here. I can't accept that loss. The implied volatility is very high. I'm just going to sell a bunch of puts because this sucker can't go lower. And then when it goes back up and as time passes and as volatility comes down, I'm going to make all that money back and a little bit more for pain and suffering, right? Who's ever done that before? Get that hand up here. Wait, boop, 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 right? Get that hand up. I've done it. It's not necessarily a good idea. We don't want to average price with options. You know what I mean by average price? Average pricing is an investing concept, and it's rooted in the idea that no mere mortal can time the market. Now, is that true? I don't know if that's true. I think there's a lot of truth to it. I'm not going to lie to you. I have had people tell me they can time the market, and some of those people I know were kidding themselves. And some of those people, I'm not sure. Maybe they could. But I also know that when I try to time the market, like, oh, looks like there should be a pullback. There's so many times that I'm right, but I'm not right until months afterwards. And if you like load up on long puts to hedge or to speculate because the market's overpriced, well, who was it? Keynes, I think, who said the market can remain irrational longer than you can remain solvent. No, that wasn't Keynes. Who was that? Oh, I forget. One of the Fed governors. So, yeah, it's very difficult, if not impossible, to time the market. And so, what average pricing is hey, this stock here is cheap by whatever method I'm using to determine that. And so, I'm going to buy some of it. And 2 weeks later, a month later, oh, I've got some more money. I'm going to buy some more of it. Is the price higher or lower? I don't care. In the long run, I'm going to have an average price and it's going to be great. If the market's lower, um, that's good. I get to buy it cheaper. If it's higher, well, I can't time the market anyway. And a month from now, it could be even higher. So I'm just going to get a good average price. Using options to do that just adds a lot of elements that cause problems. So I'm going to give you some great bonus stuff. Some of you who may be familiar with the stock repair strategy already, I'm going to give you an extra stock repair strategy that maybe you have never considered before. This is the small declines in stock price, stock repair strategy. For small declines in a stock price, in the money covered calls might be the solution. Now, we'll back up for a second here. When you buy a stock, you tend to buy it at or closer to the offer than the bid. And so when the broker values it, it tends to typically show up as a loss right off the bat. And let's face it, 50% of the time, 15 minutes later, it's going to be higher. And the other 50% of the time, 15 minutes, it's going to be lower. So you're almost always over time, most of the time, you're going to show some sort of small loss. So we're not worried about real small losses. We're worried about bigger small losses. Okay. So the premise here is I want my money back, but I'm willing to give up upside appreciation. And I'm willing to hold the stock if it falls because I think that it's cheap here. I'm okay selling for a break even. I just want my money back. Now, there's a few things going on here. Golly, I could do a whole presentation just on this slide alone. So, first, I'm willing, well, let's pair these things together. I'm willing to hold the stock if it falls, and I'm okay selling it for break even. First of all, am I lying to myself? This is a concept that I'm exploring in my book that comes out in the spring of next year. Am I lying to myself? If I do this trade and the stock takes off, and I get out just for break even, but I could have made money on it, am I going to be mad at myself? You can't lie to yourself. And am I having what is called cognitive dissonance? For all you psychology nerds out there, that's a concept developed in the late 50s by a guy named Leon Festinger. And what it means is you believe two thoughts that are mutually exclusive. It's like I believe the sky is blue and I believe the sky is red. Can't be both. I mean, I guess it could be one of those skies where there's a little blue with some red clouds in it. But I believe this number is one, and I believe this number is two. Can't be both. So, are you having cognitive dissonance with this? Are you really willing to hold the stock here if it falls because you think it's underpriced, but you're also willing to sell this stock if it goes up and just get your money back and get out? Because at that point, you feel like it's less overvalued or it's less undervalued there or something. You're not always going to have this. So a lot of times you're better off just waiting this out, but sometimes you're not going to have cognitive dissonance and you're not going to be lying to yourself. And this makes perfect sense. So let's talk about this. Let's say you bought a stock at $75 and it's down $2 to 73. Now, again, personally, I'm unlikely to care about this if this is an investment. If it's a trade, okay, maybe I'll care. If it's an investment, I don't know, maybe I won't care. So what I could consider doing is selling the 70 strike call for $5. Now, if the stock is currently at 73, that means the 70 call is in the money by $3. That means it has $3 of what we call intrinsic value. And so I'm selling it at 5. So that means there's $2 of time value. Time value is the key to this strategy. If, let's just say I do this. I bought the stock at 75, fell to 73, I'm down $2. I sell the 70 call at $5. Now let's say the stock, let's look at some different permutations. Let's say, first of all, the stock doesn't move at all. Okay. If the stock doesn't move at all between now and expiration, at expiration, those calls are still in the money. I'm going to get assigned and I'm going to sell the stock at 70, right? But I still have that $5, right? So if my effective sales price is 75, which incidentally is exactly where I bought the stock. I break even. The stock doesn't move. Gosh, I'm in great shape. In fact, I'm in great shape even if it goes all the way up to 75. If it goes up above 75, let's say to 77, well, I left money on the table. Would I be okay with that? There are some times when that answer is going to be decisively, no, I am not okay with that. I thought this stock was undervalued. I bought it, thought it was going to go up, and I got myself into the situation where I didn't make money when it went up. There's some times when you're going to choose not to do this strategy, but there are some times when this is a perfect strategy. There's sometimes when this makes all the sense in the world. So we have to think about it. Also, another permutation. What if the stock continues going lower? Well, if I already lost $2 from 75 to 73, let's say it goes down to 71. Well, it goes down to 71. Oh, well, I still get a sign because the strike is 70, right? So I sell the stock that is worth 71 at 70, so I lose $1. In addition to the $2 that I lost when I went from 75 to 73 and the $2 I lost when I went from 73 to 71. So I'm down a total of $5, but I collected $5 when I sold the call. So I'm in good shape. Actually, now that I think about it, the break even is really 70, right? Because I'd have lost $5 from it going to 75 to 70, but I have $5 from selling the option. Whether it's intrinsic value or time value doesn't matter at that point. So as long as it stays, so basically, if you think about it, where does this strategy make sense? It makes sense if the stock stays between 70 and 75 between now and expiration, which is a reasonably good range. It's like 8% or something, right? All right. Couple potential issues. We might not want to hold the stock after that first $2 because maybe that means our thesis was wrong. Maybe that means some new news came out. Earnings came out and they underperformed surprisingly. And it was the second quarter in a year where they had lower earnings than the previous quarter. Maybe the tides have turned and we don't want to hold that stock. Maybe if we sell the in the money option, depending on the strike proximity, we might not be able to get enough time premium for it to matter because the time premium is the real thing. If you think about it, the intrinsic value is sort of like a one-to-one hedge. The time value is the extra bonus you get for being smart. So, okay, there's one situation. I'll use that probably about twice a year. I don't use it that often. Stock repair strategy. This one, I probably also use a couple times a year. If there's a big down move in the market, I might do this on 3 or 4 stocks. But this is different. Let's say I own existing shares that have lost value, but this is for a bigger move lower. Stock repair strategy can be used under certain circumstances and can make back the entire loss if the stock retraces just part, really about halfway from where I bought the stock to where the stock is now. So let's take a look. Let's say I own shares that have lost value. I'm going to buy what is known as a 1x2 call spread. This can also be called a ratio vertical spread. Call it either one. And I'm going to do it with 2 to 6 months until expiration. And the strikes that I select are important. I'm going to buy an at the money call and I'm going to sell 2 out of the money calls at a strike that coincides with the price I think the stock can get to, which for this to work, I would only do that if I think that it can get to about halfway from where it was when I bought it to where it is now. Retrace halfway. Now, there's a saying attributed to Yogi Berra. In theory and practice are the same. In practice, they're not. So This slide represents the, in theory, textbook way to do it. And it's never going to work out this way. But it doesn't matter. As long as it works out kind of sort of like this can be an excellent, excellent strategy. So let's put some numbers to it, shall we? Let's say we've got some stock. We bought it at 80. Now it's at 60. And we think it can go back to 70. I'm going to buy one of the December 60 calls, which happens to be right exactly at the money at $4. And I'm going to sell two December 70 calls, which happens to be exactly smack dab between where I bought the stock and where it is now. I'm going to sell those two at $2. So for the option component, I'm paying out $4 on the 60 calls, and I'm taking in $4 on two of the December 70 calls at 2. So I'm paying 4, I'm collecting 4, I'm putting on this option trade for no money. It's free. Is it free? Well, that is kind of the same concept of how you invest in your option trading education, right? There's time and there's money. Just because you don't pay money for something doesn't mean it's free, right? You keep coming back here week after week, investing time instead of money. Honestly, if you're doing something like one-on-one coaching where somebody's showing you exactly what to do for your exact situation, you could learn in a fraction of the time what it might take you years to learn, investing time. You pay money to save time, right? Because time is more valuable. Well, it's kind of the same thing here, right? We're not paying any extra money, but there's another cost. The cost is we don't profit if the stock goes back up above 2 or through 80. We're making a deal where I'm going to get this great benefit of being able to get my money back, and it's literally going to cost me nothing. But the trade-off is, well, if it goes above 60, you're never going to get back more than your money. Is that a good trade-off? You can't answer that question in a hypothetical scenario. There are going to be some times when that answer is yes, and there are going to be some times when that answer is no. You ask yourself that question at the time, and you'll make the right decision. The idea here is if it goes up a little bit, we can profit on both the stock and the options position if the stock rises. Now, this is just like what I mentioned before about, buying calls to not really average price, but double up. Except what's the difference? The difference is when you're buying calls, probably volatility is higher when the stock is down, so they're expensive, and you have time decay working against you. And if it's not above the strike price at expiration with intrinsic value, they can be worth 0. So you can actually be right. The stock could go up and you could still lose on your calls. There's just lots of problems with buying the calls. So this is a way to buy the calls without paying for the calls. Well, without paying money for the calls. You're paying for the calls with this idea of giving up upside, agreeing just to get your money back and not any additional profits. So we want to profit on both the stock and, in a perfect world, the entire option position. We want to profit on the delta of the 60 call going up and the theta of the December 70 calls expiring worthless. Wouldn't that be great? So basically the idea is with the stock down 20 bucks, we can make all of our money back if the stock rises 10 bucks. And that looks something kind of, sort of like this. We're long stock from 80, which is now at 60. We buy one of the December 60 calls at 4, sell two of the December 70 calls at 2, 0 for that thing. What if the stock is below 60 at December expiration? What do we have? Got the same thing we had already. The options, all the options would expire, all of them. And so how much on the options? Nothing. We paid nothing for the options overall. They all expire. We don't lose or make anything. We still have the stock. So the important thing here is, do I want to keep the stock? Am I okay holding the stock and taking the risk that it could go even lower? Sometimes that answer is going to be hell no. And sometimes that answer is going to be, yeah, I am actually. I thought it was an okay buy at 80. Now, from a valuation standpoint, it's a much better buy at 60. If it goes lower, gosh, it's great. That's not always going to be the case. If, they had a lousy earnings or something changed, it might not be the case, but sometimes will be. So this helps you decide when you might want to do this. You'd only want to do it if you're still willing to hold the stock and endure more downside risk. The benefit is if it's above 60 and below 70. Because if the stock is above 60 at December expiration, I will exercise my 60 calls and I'll have another 100 shares long from 60. So if it's at 61, not only do I make $1 on the stock that was sitting at 60 when I did the options, but I also make $1 on the new stock that I got from exercising my calls, my 60 straight calls. If the stock's at 65, not only will I make $5 from the stock going from 60 to 65 from when I put the option trade on, but I'll also make $5 on exercising my December 60 calls. So I make $10 if the stock goes up 5. If it goes up $10, I make 20 bucks. Holy cow, that's what I lost. But what if the stock is above 70? Well, if the stock is above 70, then my 70 calls get assigned. And I sell 200 shares at 70. Now, wait a minute. 200 shares. I only have 100 shares. Wrongo. I have the original 100 shares plus the 100 shares I get from exercising the December 60 calls. So when I first bought this, the stock was at 80. Then it went to 60 and I put on the option trade. And so the stock went from 60 to 70. So I made back $10 on the stock, on the original stock. And I made $10 on the stock that I exercised my 60 calls at to buy the stock at 60. So I'm good. Sell it at 70, boom. I've got no more position. I'm out of the trade. I broke even and life is good. What more could I ask for? Well, I mean, if the stock is at 100, It'd kind of be nice if I made more money, but that's not the deal I'm making. You're always paying for something. Here, you don't pay for the options, but you do pay by giving up that upside. Interesting concept, right? I have got some stocks right now in my portfolio that are down, and I did not use this strategy. But then, time to time, I've got stocks where I do use the strategy. Good way to think about this is it's basically a covered call, one covered call, because I have long stock and I'm short one of the 70 calls against that long stock, and a debit spread. The other short 70 call gets paired off with the long 60 call. Or I could think of it as one covered call, the long stock in one of the 70 calls, plus a potential another covered call, the long stock I'll get if I exercise the 60 calls with the other 70 call. There's lots of different ways to think about it. So now that you see how it works, it becomes a lot easier to set appropriate parameters. And one thing we need to think about is the time horizon. For the 1x2 prices to work, the trade usually needs to be 2 to 6 months until expiration. So what if I think, boy, this stock, I think it's going to retrace halfway over the next 3 days. This is not the strategy for you. What if I think, man, I think it'll retrace halfway from where I bought it to where it is now over 2 years? This is not the strategy for you. If it's 2 to 6 months, this might be the strategy for you. You have to line up some, you have to take a look at what it looks like. It tends to work best if the stock lost 20 to 35% of its value. If it just lost a couple of bucks, either do nothing or use the in the money covered call. If it lost 90% of its value, this is not strategy for you either. The long strike is at the money. What does at the money mean? At the money means the strike is exactly the same as the stock price. Well, it's never going to be exactly the same as the stock price. It's going to be either a little higher or it's going to be a little lower. The short strike is halfway between where the stock is now to where it was when you bought it. Well, it's never going to be exactly halfway. The strike is never going to sit exactly there. It's going to be either a little more or a little less, and that's okay. But we only trade this if we're expecting about a halfway retracement to the strike that we can sell. So let's look at an example. Let's say back in March, we decided to buy the Apple shares of Apple at 245 bucks. Now it's at 215 bucks. And this is like near the end of July. Well, let's say we consider what's going on with Apple. They're going to end up with higher costs, whether that's because of tariffs or because labor in America costs more than labor in China or India. And they're between those two situations. Either keep paying cheap labor in China and India and pay higher tariffs, or move it to America and pay higher labor, but not pay tariffs. Either way, let's face it, costs are likely to go up for Apple in the foreseeable future. So And I'm not necessarily, this is still just an example, but I'm trying to make this a pretty realistic example. So let's say for that reason, I don't think Apple's going to rise all the way back to 245, but I think it's going to rise back some. Apple's down 30 bucks, 12%, which is a little bit lower than our, than our real target here of 20%. But sometimes you can still make it work. So I wanted to show this as an example. And it recently bounced off its lows, showing signs of a comeback in this example. We think it won't go much lower because, for whatever reason, we think that. We're looking for a partial retracement. Apple has mild resistance at 230, which is below where we bought it originally. We think maybe it can get up to about 230 over the next 3 months, we'll say. Again, this is all hypothetical, but pretty realistic. So the plan. We don't plan to sell our shares if it goes lower. We're willing to accept that downside risk. Now, I want to clarify something. I'm not saying that if you do the stock repair strategy, your plan should be to not sell the shares. What I'm saying is the opposite. If your plan is to not sell the shares, I might consider doing the stock repair strategy. You see that difference? It's not really even that subtle. If my plan is to not sell the shares, then I might do this. And if I'm happy to get out with a full refund, get all my money back, if the stock rallies halfway to my original buy price, then I might do the trade. This is not, okay, I'll do the stock repair strategy. And so I guess I'm happy to get out with the full refund if the stock rallies halfway. No. It's if, man, I just want my frickin' money back. I didn't see this coming. This really stinks. Options gods, I swear I'll never do this again if you just give me my money back. Right? You ever done that before? Yes, you have. Don't lie to me. Don't lie to me. Lie to your kids about Santa Claus. Don't lie to me, and especially don't lie to yourself. Okay? You've done that before. This is for that situation where you're praying to the options trading and investing gods. Oh, if I could just get my money back, I swear I'll never do that again. And I promise I'll be happy. I just want the money back. I don't mind leaving money on the table. It's okay. Just give me my money back, please. If you feel that way, and you wouldn't be selling your shares here, this can be an excellent strategy. So here's what we do. Remember, we originally bought the stock at 245. Now it's at 215. So we'd buy the 215 calls, which we can buy at 1165. And we'd sell the 230 calls halfway, which incidentally, there's resistance at 230 at $5. Now, notably here, in October, which when we took the screenshot, there was 86 days to expiration, so about 3 months. We're paying $11.65 and collecting $5 twice, so 10. So this is not for zero. We're actually paying for the spread. So we have an extra $1.65 worth of risk here. But it's just $1.65. That's like 0.5%. If I lost 12%, what's an extra 0.5%? Right? So here's what we end up with. Remember, I bought it here. Now it's here. There's resistance here, and I think you can get to here by October expiration. So, oh, Alex says, this would have been great to know when I bought 1,000 shares of Intel at 30. Tell you what, I have a position in Intel as well. This might be an interesting one for Intel, might it not? With I don't know. I mean, I'd have to think about it. I'm definitely not saying it is, but might be. I'd have to think a little bit more about it. But the Trump administration announced that they might consider taking a 10% share in Intel. I mean, look at that news on your own to double check me. I think I remember hearing something like that. But, you know, that's bullish. If it's not bullish, it at least puts a floor on it. So, yeah, that could be interesting. That could be a situation where, sure, I'm okay holding it because if the government's going to, buy a 10% stake, what does that mean? Buying the share price? Well, I mean, that's like support, right? So interesting. So that's an interesting one to look at. I don't have that position on. I have a different position on, but I've been following Intel pretty closely. So we get kind of the same thing here, right? We get this. We get if the stock is up 15 bucks, we make almost 30 bucks. We make $28.35. Why $28.35? Well, actually, let's go back here. Because we paid $1.65 for this. So if we're at 230, we make 15 bucks on the stock going from 215 to 230. That's the original share price. Plus, we exercise our 215 calls to buy more shares at 215. But because we paid $1.65 for the spread, it's actually like paying 216, 216.65. So we actually would make $28.35. Not too bad. Got back just about all of our money, right? But if the stock is above 30, let's work backwards. If the stock is above 30, well, our 230 calls are going to get assigned and we're going to sell that stock at 230. So we lost 30 bucks, but we're making back 28.35. Okay, call it a day. We just about broke even. Thank you, options gods. Right? It's just what we wanted to happen. What do you mean the stock is at 275? Son of a. No, you're not going to do that. You're going to stick with the agreement that you made to yourself, not the options gods, yourself, right? And you're going to be happy that you just got your money back. If the stock is between the two strike prices, we're going to want to close this before expiration because what we don't want to have happen is get assigned, buy an extra 100 shares, and then Monday morning the stock opens, at 205. We want to close this sucker on expiration day regardless, or before. If the stock is below 215, then hey, I only invested another $1.65, not the end of the world. I was planning on holding it anyway, not the end of the world. Now, Vince asks a great question that I get fairly commonly. Can we do this 1x3? Now, why would you want to do it 1x3? Well, I think Vince's reasoning here is because then I'm collecting even a third premium, and maybe, just maybe, it'll not just offset what I pay for the long call that I need, but maybe even I can do this trade for a credit. Or I could do a shorter term trade where the out of the money calls don't have as much value, and I need to sell 3 to cover the cost of the one I'm buying. Well, let's explore what happens if you do that. Oh, or to move the strike even higher. Yeah, right. There's 3 scenarios. Could be even more, but yeah, good thinking. So let's just say for this, just to make this easy, we sold 3 calls. Well, below the strike doesn't matter, right? All the options still expire. Between the strikes, it doesn't matter either because we're only buying 1 call per 100 shares. But the problem is above 230, we'd kind of be in some trouble. In fact, here, I'll just throw I'll just make a little slide on the fly here. We'd end up with, oops, let me move this out of the way. I love this question, by the way. We'd end up with something that looks kind of like this. So it could be good, but if it's one of those situations where it actually goes up to and or through where we paid for it, we can end up losing some money. And I mean, I'll tell you what, if it's an investment, I don't think that this is the way to do it. If it's a trade, I've done trades like this before. I just took off a broken wing butterfly. Well, I let expire a broken wing butterfly in a different stock that had a P&L diagram that looked kind of sort of like this. So that's why if you're an investor and you just want your money back, I don't like having that extra risk. But there are some circumstances when it could be possible that I'd think about that. So the idea here is we lost 30 bucks on the initial trade. We only spent $1.65 of additional risk. If the stock continues to fall more below 215, still own the stock. We only lose an extra 0.5%. Between 215 and 230, we're long 200 shares, double up to catch up. Not like ketchup and mustard, but catch up, like catch up to somebody. Which reminds me of that joke. You know that joke? Never mind. I'm not going to tell it. My jokes are terrible. I have dad jokes and all I get is eye rolls. And I don't want you to hurt your, like your retinal nerve or whatever by rolling your eyes at my jokes because they're so bad. But anyway, double up to catch up between the 2 strike prices. And above 230, if we're doing this 1 by 2, the classic way, the original shares and the new shares that we got from exercising the 230 calls get called away and the stock is gone. We're back to about even and we're happy as a pig in mud. All right, friends. That's all the time we have for today. What do we have next week? Oh my gosh, we have secrets to investing with cash secured puts. Holy cow. That is something that I have done massive amounts of work on lately. Just investing with cash secured puts, and you're going to love it. So much great stuff to share next week. Make sure you show up, mark your calendar now, tell your friends, take off work, declare it a personal holiday, sick day, whatever it is. And I will see you in 7 days minus 1 hour. Talk soon. Have a great rest of your day and week. Trade smart.